A parliamentary election in the Netherlands normally has no impact on the global stock markets. But what is normal after Brexit and after Trump? And this is a reason why the investors have also a focus on the Dutch election. Because in the super election year 2017, the future of the European Union and the euro is at its stake. And these are the topics of today's Werthstein Index update. A victory of the right-wing populist in Dutch could influence in the election in France. Investors are getting nervous, so some risks are priced already in, meaning that the markets could rise further if in the end the political risks are not materialized. But there is another risk, the next meeting of the US Federal Reserve. And the probability of a next rate hike already in March is rising.
Geert Wilders is seen by some investors as the Dutch Trump. The head of the Party for Freedom evokes the patriotic spring, and if he wins, he could help her into office. Marine Le Pen, head of the Front National, has a clear lead in the polls 6 weeks before the first round of the French presidential election. She is nowhere near as successful, but in Germany too, Frauke Petri's AfD could make life difficult for the political establishment.
Valle Pagnol, Werthstein Institute fellow in Paris. What are the feelings of the French people looking on the happening in the Dutch election?
Well, you know, it is no secret that Marine Le Pen's opinions and program has a lot in common with the front runner in Dutch election, Geert Wilders. And I think his result at the weekend's election will probably influence Marine's performance in France.
Marine Le Pen as a new president in France, possible indeed?
Well, as you can see on the charts, the spreads between the French bonds and the German bonds have widened enough, and that means markets are pricing in that possibility. Now, it doesn't seem to be the case when I look at opinion polls, although Marine Le Pen is running well ahead in the first round of the elections, she would still be second in the final race and the second round, according to opinion polls at this point. But that could be by a narrow margin.
Giles Keating, Werthstein president in London. Despite a rising stock market, a certain nervousness is felt, right?
Yes, well, we can see that, as Valerie's just mentioned, in the movement in those French bonds, which is definitely showing a bit of concern about politics in Europe. And more generally, I think investors are worried, or some investors are, that valuations are just getting a little bit high.
Look at the next Federal Reserve meeting. Do we see a next rate hike already in March?
Well, I think that's another factor. Clearly, the Fed has now signalled it's highly likely to be raising rates in March. And although in some ways that's good because it's telling us that they believe the economy is strong, it also is not so good because higher interest rates tend to act as a drag on stock markets.
Bob Parker, senior advisor at Credit Suisse in London. A possible rate hike in the US and a lot of political risks in Europe. In what way is this influencing your investment decisions?
Economic data coming out of the United States, I think, is very clear, suggesting growth accelerating to 2.5% plus, and likewise headline and core inflation rising. Consequently, I think that the Federal Reserve will raise rates 3 times this year, and that will put pressure eventually on global bond markets. That's risk factor number 1. Risk factor number 2, obviously a series of quite dangerous potential political risks in Europe, whether it be the Netherlands, France, and eventually the election in Germany, where Mrs. Merkel's chancellorship is not guaranteed. So all of that risk, I think, at a time when valuations are high, suggests that one needs to be much more cautious in investment strategy.
Robert Ruttmann, Werthstein Institute Honorary Fellow in Zurich. Rising interest rates are normally poison for the stock markets. Do we soon see falling markets?
Not necessarily due to higher interest rates. I think this has essentially become a consensus opinion. But I do think that markets are priced for perfection. Investors are expecting above-trend economic growth, steady inflation, and even strong corporate earnings. Any disappointment to these high expectations, I think, could cause a correction.
Bob Parker, if you have to rate the stock market now on a scale of 1 to 10, what would be your vote currently?
I regret to say my rating would be a 1, given that valuations are high, and I think the raft of risks are starting to concern investors.
Bob Parker voted with a very negative 1, which, however, is not included in the Werthstein Index. It's a lively representation of the Werthstein Institute's market opinion. It expresses the individual voting members' expectations for the development of the global stock markets over a time horizon up to 3 months as the average of votes on a scale of 1 very negative to 10 very positive. Look at the current votes.
Yes, I think that markets are priced for perfection at the moment, which leaves a very high potential for disappointment. And for this reason, I stay with my 2 vote.
Well, actually, I tend to agree with Robert, and for that reason, because I was slightly more optimistic, I will still also be standing by and staying with my own note of 4.
Well, my vote is also, I'm staying at 2. So, and I'm doing that because I am still cautious and I'm concerned that valuations are a bit high. So, put it all together, my vote at 2, Valerie at 4, Robert at 2, that's a total of 8. On average, that's 2.7, which is the same as last month and signals continued caution by the Werthstein Institute.
The stock markets are continuing to rise, which means that the risk of a major correction will be higher, says the Werthstein Institute. Giles Keating, why doesn't the correction come?
Well, one of the reasons is that institutions are still holding a little bit more cash now than they normally do. So they're pretty reluctant to sell, and even if they see a dip, then they may want to buy. And then on top of that, there's a lot of retail people who I think got left behind in the rally, and they're still catching up.
So there could still be some upside?
Well, it is still possible because of that kind of weight of money. But weight of money is always a dangerous argument. And in fact, we have begun to see a bit more shakiness in the stock market. So yes, there could be a little bit of upside, but I think there is also a sense it's possible that we're now actually even starting the correction.
But what about the US Fed?
Well, it does now look as though the Fed is going to go ahead very, very probably and raise rates in March. And they may well signal that they're actually going to accelerate the pace of rate increases after that. Now, that does tend to act as a drag on the stock market, although there is a bit of a silver lining, which is they are raising rates because the US economy is performing well. You can see that if you look at the business survey, the Purchasing Managers Index. So the Fed is a little bit of a drag, but it's also a signal that fundamentally the economy is okay. And that in turn tells us that the stock market, although it could correct a bit, is not in crazy territory.
A possible interest rate hike in the US and some political uncertainty, especially for Europe ahead. The Werthstein Institute stays cautious with seeing rising risks, a broader correction in the markets. Maybe we will not join the last step of the rally, but that's better than losing money. We will keep you updated with our decisions.